73% of traders who blow their account do it on a trade they knew was wrong before they clicked buy. Let that sink in for a moment. You didn't fail because you lacked information. You didn't fail because the chart didn't cooperate. You failed because your brain betrayed you at the exact millisecond discipline mattered most. Welcome to the hidden psychology of risk management. Today, we are going to tear apart the illusion of trading accuracy and look at the brutal mathematical reality that destroys accounts every single day. Let's start with a hard truth that nobody in the flashy online trading world wants to admit. You can have a 60% win rate, a beautiful strategy, expensive monitors, and a custom ergonomic chair, and still end up completely broke in less than 30 days. How is that even possible? It happens because retail traders are obsessed with being right, while professional market makers are obsessed with survival. Imagine you step into a casino. You find a game where you win 7 out of 10 hands. You feel like a genius. Your confidence is through the roof. But there is a catch. On the 3 hands you lose 10 times your initial bet. Within an hour, your entire bankroll is wiped out, even though you won the majority of the rounds. This is the exact trap that catches thousands of day traders every single week. They focus all their mental energy on predicting market direction, studying indicators, drawing trend lines, and scanning news feeds. They treat trading like an academic test where getting an A+ means making money. But the market is not an exam. It is a probability machine. It doesn't care how smart your analysis is. It only cares about how much capital you are willing to sacrifice when you are wrong. Let's break down the mechanics of this trap using a real-world analogy. Think of a pilot flying a commercial airliner. Do you think the pilot spends 90% of their time worrying about how beautiful the takeoff is? Or do they spend their training mastering emergency landings, engine failures, and severe turbulence? The takeoff is exciting. Everyone loves the climb. But the pilot's true skill is measured by their ability to bring the plane down safely when everything goes wrong. In trading, your entry strategy is the takeoff. Risk management is the parachute. Most traders spend all their time designing the cockpit and zero time packing the parachute. They enter a trade with a massive position size because the setup looks pristine. The chart patterns are aligned. The moving averages are crossing. The volume is spiking. It feels like a sure thing. So they risk 10, 15, or 20% of their total account on one single idea. And right there, before the candle even closes, they have already lost the game. Because the market doesn't owe you anything. A pristine setup can fail in a single second due to an unexpected headline, a sudden liquidity sweep, or a simple shift in institutional order flow. When that happens, the trader with oversized risk faces a terrifying psychological dilemma. Their position is deep in the red. Their heart rate spikes. Sweat beads on their forehead. Their brain instantly shifts from a rational analytical state into a primitive survival response. Fight or flight. But in trading, you can't run away from your position, and you can't punch the monitor. So you freeze. Or worse, you average down. You throw good money after bad, convincing yourself that the market has to bounce back because it makes logical sense. That is the moment overtrading is born. That is the moment revenge trading takes over your nervous system. You are no longer trading the chart in front of you. You are trading your bruised ego, trying to force the market to apologize for making you look foolish. Remember this core principle: mastering your risk parameters is the only real edge you will ever possess in the financial markets. Now, let's transition from the illusion of win rate into the actual mechanics of ruin. What happens inside the mind of a trader who experiences a losing streak? Let's trace the psychological cascade step by step. Every trader starts the week with a clean slate. You take your first trade, and it loses. It's totally normal. Every professional takes losses. Losses are simply the cost of doing business. But then you take a second trade, and it loses too. Now a subtle shift occurs in your mental state. Your internal monologue changes from calm analysis to defensive urgency. You feel a quiet, creeping pressure to recover those losses before the trading session ends. This is where the trap snaps shut. On your third trade, you see a setup that looks okay, not great, just okay. But because you are down on the day, your brain inflates the quality of the setup. It looks amazing through the lens of desperation. You increase your position size to make up for the previous losses. You widen your stop loss because you want to give the trade room to breathe. And what happens? The market sweeps right through your wider stop, inflicting a catastrophic loss that wipes out not just today's profits, but half your monthly gains in a matter of minutes. This is the classic emotional doom loop. You try to outsmart probability through sheer willpower, and the market humbles you instantly. To break this cycle, you have to adopt a completely different mindset. You must stop viewing trades as individual battles that you need to win, and start viewing them as a long, continuous series of hundreds of independent mathematical events. Imagine rolling a fair six-sided die 500 times. You know for a fact that you will roll some ones, twos, and threes. You don't get angry when a 1 appears. You don't curse the die. You don't double your next bet to punish the die for rolling a low number. You simply accept that variance is built into the game. Yet, the moment the same person sits in front of a trading terminal, all statistical thinking evaporates. A single losing trade feels like a personal insult. A string of 3 losses feels like a crisis. Why does this happen? Because money is deeply tied to our sense of self-worth and survival. When your account balance drops, your primal brain interprets that financial loss as a literal threat to your existence. It triggers the same neural pathways as physical danger. Your prefrontal cortex, the part of your brain responsible for logic, discipline, and long-term planning, goes offline. In its place, the amygdala takes over. The amygdala doesn't do complex math. It doesn't calculate risk-to-reward ratios. It only knows how to panic, fight, or freeze. This is why intelligent, educated people make irrational trading decisions that shock them afterward. You are not fighting the market. You are fighting millions of years of evolutionary biology every time you stare at an open loss. Understanding this biological reality changes everything. It teaches you that discipline is not just about being strong-willed. True discipline is about setting up structural guardrails that protect you from yourself when your rational mind shuts down. It means automating your stop losses before you even enter a trade, so you don't have to rely on willpower in the heat of the moment. It means defining your maximum daily loss in writing, walking away from the desk the second you hit that number, and locking your platform. Professionals treat their risk rules like sacred laws. Amateurs treat their risk rules like flexible guidelines that can be bent whenever a really good opportunity comes along. Let's look closely at how prop firm challenges exploit this exact psychological weakness. Thousands of aspiring traders sign up for evaluation accounts every month, chasing the dream of funded capital. The rules seem straightforward: make 10%, don't lose more than 5%. But the psychological pressure of those rigid drawdown limits creates a toxic mental environment. Traders start calculating every tick in terms of pass or fail. They become paralyzed by fear, or conversely, they take reckless gambles on Friday afternoon trying to hit the profit target before the weekly cutoff. The prop firm business model doesn't rely purely on charging application fees. It relies on the certainty that human beings under financial pressure will eventually abandon their risk management rules. When you trade with money you cannot afford to lose, or when you trade under the suffocating pressure of an arbitrary deadline, your emotional vulnerability skyrockets. You stop seeing charts and start seeing your last chance at financial freedom. That desperation is a beacon for the market. Markets are giant liquidity sponges that absorb the capital of the emotional, impatient, and over-leveraged, and transfer it directly to the calm, patient, and risk-aware. If you want to survive long enough to become consistently profitable, you must ruthlessly eliminate desperation from your trading routine. You must accept that some days the market will offer nothing, and sitting on your hands doing nothing is actually a winning trade. Most retail traders cannot handle boredom. They feel an overwhelming urge to click buttons because activity feels like productivity. They open marginal trades simply to feel alive, to experience the dopamine hit of a live position fluctuating on the screen. But real trading is agonizingly boring. It is 95% waiting and 5% execution. If you find yourself craving excitement in the markets, you are playing the wrong game. Go to a casino, ride a roller coaster, or watch a thriller movie. Leave your capital out of it. Because trading is an unyielding mirror. It exposes every single flaw in your character, every hidden insecurity, every instance of impatience, and every refusal to accept responsibility. If you have an ego, the market will find it, isolate it, and punish it until you have nothing left. But if you can develop radical self-awareness, if you can look at a devastating loss without making excuses, if you can ruthlessly cut a trade the second your thesis is invalidated without hoping and praying for a miracle, then you begin the slow, arduous transformation from a struggling retail gambler into a disciplined market professional. Remember that risk management is not a mathematical formula you memorize from a textbook. It is a psychological armor you forge through constant, painful self-correction. Every time you respect your stop-loss, every time you walk away after hitting your daily drawdown limit, every time you refuse to chase a runaway candle, you are starving the emotional monster inside your mind. The market will always be unpredictable. Volatility will always expand and contract. News events will always shock the system. You cannot control what the price does on the screen. You cannot control the algorithms, the central banks, or the global macroeconomics. The only variable you control, the only weapon you have in this entire arena, is the size of your risk and the boundaries of your discipline. Master your risk parameters before every trade, or the market will master your account until nothing is left.